Breaking news, we have a major breach.
PayPal and Venmo are down globally.
This is total financial chaos.
What if a single 84-minute glitch could erase over $640 million in value? What if one of the world's biggest financial technology companies was hiding a pattern of systemic failure so severe it threatened its very existence? On October 16, 2025, thousands of people asking, "Is Venmo down?" or "Is PayPal down?" had no idea they were witnessing the financial breaking point of a $200 billion empire. This wasn't just a PayPal-Venmo outage. It was a symptom of a disease that has been silently spreading through the heart of PayPal's infrastructure for years. And the full story is far worse than you think. From Wall Street to your wallet, this is Smart Money Sense. On the morning of October 16, 2025, the digital world shuddered. At approximately 11:15 a.m. Eastern Time, the seemingly impenetrable fortress of PayPal and its powerhouse subsidiary Venmo began to crumble. Users trying to log in, send money, or check their balances were met with error messages and frozen screens. On Down Detector, the reports surged like a tidal wave, over 20,000 in a matter of minutes. Panic spread across social media. "I'm locked out of my money," one user posted on X. Another wrote, "My business runs on PayPal. Today, my business is dead." This was the public face of the PayPal-Venmo outage. But behind the scenes, a financial disaster was unfolding at a staggering speed. To understand the true scale of this event, we need to go beyond the headlines and into the numbers. And the numbers are terrifying. Let's start with the most direct cost: lost transactions. In the second quarter of 2025, PayPal processed $444 billion. That averages out to nearly $5 billion in payments every single day. The October 16th PayPal-Venmo outage lasted for an average of 84 minutes during the peak business hours. Based on these figures, we can estimate that PayPal failed to process somewhere between $285 million and $342 million in payments. Now, that's lost volume, not lost revenue. PayPal makes its money from fees, assuming an average transaction fee of 2.9%. That 84-minute window cost PayPal between $8.3 and $10 million in direct revenue. Gone. Vanished into the digital ether because their system failed. And that doesn't even count the smaller high-margin fees like instant transfers, which likely added another $100,000 in losses. For a company, that's not just a bad day. It's a catastrophic failure of its core business function. But the immediate revenue loss is just the tip of the iceberg. The real damage from a PayPal-Venmo outage is measured in market confidence. And on Wall Street, confidence is everything. On the day of the outage, PayPal's stock, ticker symbol PYPL, fell over 1%. A 1% drop might not sound like much, but for a company with a market capitalization of over $62 billion, that's a $642 million loss in shareholder value. Wiped out in a single day. But even that number is misleadingly small. To see the real picture, you have to zoom out. The outage happened during an already brutal month for PayPal. The stock had hit a high of over $77 on October 9th, only to plummet 13% in the week leading up to the outage. The $642 million drop was salt in an $8.2 billion wound. Investors were already spooked. Just 3 days before the PayPal-Venmo outage, on October 13th, Goldman Sachs downgraded PayPal stock from neutral to sell, citing fears about the company's future profitability. The outage proved their fears were justified. It was the physical manifestation of the market's deepest anxieties about the company's stability. And here's a critical question. When a company's core service fails this publicly, just before a major earnings report, does it change how you see its value? Does an event like the PayPal-Venmo outage make you more or less likely to invest? Let me know your take in the comments below. Is PayPal stock a buy, a sell, or a hard pass after this? Your insights help our whole community get smarter, so don't hold back. And while you're down there, hitting that subscribe button ensures you never miss a deep dive like this, we have a lot more to uncover. Because the most terrifying part of this story isn't what happened on October 16th. It's that this was not an isolated incident. This was a pattern. The October PayPal Venmo outage was the third major system failure for the company in less than a year, and it reveals a terrifying reality about the fragility of the systems that handle our money. Let's rewind to August of 2025. In Germany, a critical PayPal fraud filtering system didn't just get a bug, it was completely or largely disrupted. This allowed a flood of unchecked, potentially fraudulent transactions to hit German banks. The banks, in a state of panic, did the only thing they could. They froze everything. Over 10 billion euros, that's nearly 12 billion US dollars, in PayPal transactions were put on ice. This wasn't just a consumer inconvenience. It was a full-blown crisis that got the attention of Germany's top financial regulator, BaFin. The incident publicly exposed that PayPal's own security systems, the very ones meant to protect users, could fail so spectacularly that they brought a nation's payment processing to a halt. And before that, in November of 2024, a different failure in PayPal's Braintree API triggered a global outage. Payments, withdrawals, crypto transactions, all down. Thousands of reports flooded in from around the world. 1 outage is an accident. 2 is a coincidence. 3 is a pattern of systemic, operational decay. Industry best practice for a mission-critical financial system is an uptime of 99.9% or better. PayPal's track record suggests it is falling dangerously short of that standard. The infrastructure that supports 434 million active accounts is showing cracks. And in the world of finance, cracks in the foundation are an invitation for competitors to tear the whole building down. While PayPal was dealing with its self-inflicted wounds from the PayPal Venmo outage, its rivals were sharpening their knives. The world of digital payments is a brutal zero-sum game. Every failed PayPal transaction is a potential new customer for Zelle, Apple Pay, or Stripe. And the data on this is chilling. Studies show that when a payment system fails, 33% of customers will immediately try a competitor. Think about that. For every 3 people who saw that "Is PayPal down?" error message, one of them likely opened another app. Let's look at the competition. Zelle, which is backed by a consortium of major US banks like JP Morgan Chase and Bank of America, is a monster. It processed over $1 trillion in 2024, more than double PayPal's volume. And it's seamlessly integrated into the banking apps millions of people already use every day. It offers instant, fee-free transfers, a direct attack on Venmo's business model. Then there's Apple Pay. With over 1.5 billion active iPhones in the world, Apple has created a frictionless payment ecosystem that commands a 92% market share for in-store contactless payments. And here's the kicker. 88% of Apple Pay users also use PayPal. They don't have to learn a new system, they just have to switch their default. The PayPal Venmo outage didn't just annoy these users, it actively trained them to use a competitor's product. This brings us to the most expensive consequence of the PayPal Venmo outage: the loss of trust. It can take years to build a loyal customer base, but just 84 minutes to start losing it. PayPal has spent years building a user base of 434 million people. But growth has stagnated, hovering at just 2%. Worse, the number of transactions per user is actually declining. The last thing a company in this position needs is to give its customers a reason to leave. But that's exactly what the outage did. Research shows that most consumers have a patience threshold of just 6 minutes for a payment disruption. After 22 minutes, they are beyond frustrated. PayPal's 84-minute outage was an eternity. For the 36 million businesses that rely on PayPal, this was even more devastating. Every failed checkout was a lost sale. Every delayed payment was a hit to their cash flow. For a small business, a day without payments isn't an inconvenience. It's an existential threat. These are the very merchants that form the backbone of PayPal's network, and the company just showed them how unreliable that backbone can be. The long-term cost of this customer exodus is staggering. PayPal has previously fought what it called a $100 million churn problem. How much will this new wave of churn cost? If just a tiny fraction, say half of 1%, of the users affected by the outage decide to leave for good, that's up to 100,000 lost accounts. With an estimated customer lifetime value of between $500 and $750, we're talking about a long-term revenue loss of $50 to $75 million from a single incident. And the cost to reacquire those customers is 5 to 7 times higher. It's a financial death spiral fueled by unreliability. This all leads to a single multi-billion-dollar dilemma for PayPal's leadership. The company is at a crossroads. Down one path lies continued decay. They can apply digital band-aids, issue apologies, and hope another major outage doesn't happen. This path leads to a slow, bleeding death as customers and merchants migrate to more reliable platforms. Down the other path lies a painful, expensive, but necessary rebirth. Addressing these systemic failures requires a monumental investment in infrastructure. We're talking about building fully redundant, geographically separate data centers with automatic failover, overhauling their fraud detection systems to have multiple independent layers, redesigning their core architecture to prevent a single point of failure from causing a global cascade. Based on industry standards, this kind of overhaul could cost between $200 and $370 million in upfront capital, plus an additional $25 to $40 million in increased operating expenses every single year. This is the $200 million plus question. Where does that money come from? Does it come from the budget for product innovation, like their crucial buy now, pay later services? Does it come from the marketing budget needed to fight off Zelle and Apple Pay? Or does it come from shareholder returns, further punishing a stock that's already down nearly 20% this year? This is the true hidden cost of the PayPal Venmo outage. It's not just the millions lost in a single day, it's the hundreds of millions that must now be spent to fix a broken foundation, all while fending off a pack of hungry competitors. The company raised its earnings forecast for 2025, projecting strong cash flow. But how much of that cash will now be diverted from growth to survival? The outage on October 16th was a wake-up call. It was a warning that the convenience of digital payments rests on a fragile technological foundation. For PayPal, it was the moment the market stopped asking, "How much can you grow?" and started asking, "Can we even trust you to stay online?" The company's next moves will be the most critical in its history. If they make the hard choice and invest heavily in reliability, they might just pull themselves back from the brink. But if they don't, we may look back at the great PayPal Venmo outage of 2025, not as a one-day glitch, but as the beginning of the end for a titan of the financial world. Now you have a clearer picture of the financial disaster behind the PayPal Venmo outage. But the story of fintech disruption is always evolving. To keep building your financial sense and stay ahead of the next big market shift, watch the video on your screen now. And if you believe in making finance make sense, join our community by subscribing so you never miss an insight. This is Smart Money Sense. Keep building your sense.